Welcome to today's episode of Financial Fluency. Today, I am so excited to have Diane Rusk with us from First Financial Services. Diane, thank you so much for joining me.
Hi, thank you so much too, Jen. Very happy to be here. Really happy.
Well, one of the reasons I was so excited to have you here is that while I like to talk about financial things a lot, I am not a financial professional. I've said that on many of the shows. And all of us who are interested in our finances really need to find someone like Diane who can walk us through the actual specifics of our own financial situation. And just before we hit record, I was telling Diane how I went and saw an estate planner this morning who has a daughter with special needs like I do, to go over the massive file that I have with all of our estate planning and our special needs trust, just to make sure I'm keeping up with things. Laws haven't changed since I established them, and just to see what else I need to be doing. And I think that everyone who has a real vested interest in their finances, which should be every single person listening to this, needs to do that kind of work as well. So Diane from First Financial Services, let's talk about what you do for entrepreneurs, for people in general.
Okay, absolutely. And good for you. That's really great to actually find the time that you did to go and meet with this person, because we tend to put things off that we don't think are immediate needs, but we just don't know in our life when things happen. What if certain things happen in our situation, and then we should have, sat down with someone. So congratulations taking that first step. That's
Thank
really
you.
awesome.
Thank you.
Yeah, for sure. So definitely, I'd like to sort of be here today to help people think about certain situations that are personal to them, maybe help them come up with some questions when they go meet with someone, that they can just say, okay, I heard about this. How does it pertain to me? Should I be doing this? So we'll go through a few things, okay? And just a little bit about my background. So, my two things that I focus on are guarantees and results. I believe that we have such an unstable financial world out there. We don't know what's going to be here tomorrow, right? We've had the dips of the 2007 and 8, the highs. So, after almost 2 decades in this business, it's been 18 years that I've been involved in life insurance and financial products that I represent. I see the need for everyone at some point to have something in their portfolio with a guarantee. And when I talk to you a little bit more, and your listeners here, about those products, I can sort of tell you how they work for different age groups, different times in your life, if you have a young family, if you're a busy entrepreneur, or even estate planning and just thinking, for the future of your family and their children and so on. So there's so much that you can sort of put together. So as I mentioned, a couple of things that are really important that I share are the guarantees and the results. Results are going to be there because you can't beat a guarantee. And there's not, right? There's not too many things in our financial, portfolio that have guarantees.
Yeah. I want to know more about those for sure, especially, I'm just going to let the listeners know, we're recording this the day before the election. So this will come out in a week or two. But I've been watching the markets kind of be like, oh, what, between Brexit and then our election, everything's just been a little.
Yeah. Absolutely.
So guarantees sound amazing.
Okay, so good. And I think, as we get older, that's a little bit more important to us too, right? We start to think, once we have our family, well, you look at your life timeline, and you're 20 to 30 and you're busy getting started with family and career. 30 to 50, we've got 20 good years to put, a effort into what we love and we do, make a career, make, some financial strides here. But it's really difficult because that's competing with all of the costs we have of just living and looking after our family, right? So those 20 years are when you really should be just putting your plan in place and just following it and reviewing it. So start somewhere, right, with some kind of plan. And I know you talk a lot about just different very good basics about budgeting and finding some money. Your mindset, knowing that it's actually there, right? You can find it.
Mm-hmm.
So taking a look at putting a financial plan in place with some guarantees. Okay, so investment-wise, there are very basic guarantees, but they don't really give you a large return, an ROI, return on your investment. So it's, we look at our parents and our grandparents, that's all they did for a lot of their investments because it was secure. And I think we got into a phase over, the last few decades where people wanted higher returns, and we saw so much possibility. Some of the guarantees that I'm suggesting should be a small portion of your portfolio, because if the markets do go crazy, if mortgages again, go, out of whack, and investments start to drop, if you have the time, it depends how old you are when these things happen, you can then gain that back. But if you don't, you still know that the investments that you've chosen that have some guarantees are rock solid. They're going to be there for you. So if you're looking at a retirement projection of, maybe 60 or 65, things that you put in place today will be there for you. They'll be a small part of your portfolio. Hopefully, you'll be able to have a few things. You'll be able to have other investments that you put aside, some really good tax sheltering advice if you are an entrepreneur or business owner, that you may, sit down with your accountant and look at different ways to do that. Insurance policies, there's cash value in those that you can use as well. Maybe there's a pension from a work or your own money that you can create. And I do want to say one thing: if you don't have any of those other, external financial avenues, what you create from yourself will be your own personal pension. And you can have a pension plan that is guaranteed, that will give you income for the rest of your life. And that's basically available through what I do on the insurance side. A lot of times people don't know that, though. Okay, so there's a lot. That threw a lot at you, right?
Is. Well, and the reason I was like, so just tell me, what are the things with guarantees? Because I feel like there are so few.
What are they?
Are we talking bonds? Are we talking annuities? Are we talking insurance, straight up insurance?
Oh, good for you. Yes, talk annuities.
Okay, annuities.
So everyone's going to go Google annuities, okay, when they're listening to this.
Well, and I know a lot of people read that Tony Robbins book, because when that Tony Robbins book came out, it was just before I started this podcast, and I had a lot of questions about annuities, and I went and did a lot of Googling myself just to be like, what exactly is he talking about? Which annuities? Because he was talking about some that you could even turn on prior to retirement age and start your own money machine. He had did you read the Tony Robbins book or any of the reviews of it?
I didn't do that, no, but I've gone to see Tony Robbins years and years ago, and so I know what you're talking about. He has some awesome options for people, and that's specifically the annuities are what I want to tell you a little bit about. So,
tell us about it.
An annuity,
I had trouble tracking down exactly what he was talking about, as a product to buy. So I would love to know more about annuities. Okay,
so you can have annuities. You can have many annuities. Okay, so this is an investment folder. So you've got an annuity. An annuity is a guarantee that is issued to you through an investment through an insurance company.
Okay.
An insurance company can give guarantees. They have a life insurance component to it as well. And I'll explain with an example. So an annuity is you giving your investment money. So let's say you have a lump sum of money. You give it to someone who's going to say, okay, first of all, thank you. Thank you for the money. We will guarantee you an annuity payment, meaning from the time that you choose to get money coming to you, so think of it as income, to the day you die, we will guarantee you this payment every month over and over again if you live to 100, okay? Regardless of what the markets are doing, regardless of any dips and anything like that, because it's a contract that is legal and binding, and it starts the day that you go into the contract for the annuity. So as an example, I had an elderly lady who had a certain amount of money, and that was all that she had left to her name. Okay. And she was about 72. So I'm just going to go through this. And Jean had about $140,000. And this was all the money she had in the world. And she was a little fearful that she's going to outlive her money. So in this case, we said, what can we do? How can we help you? So when I explained an annuity and how it was guaranteed, she would never run out of money. It was exactly what she wanted. And here's the beautiful thing: at different times and ages when you do this, for her, when she started that annuity, it was approximately $1,100 a month. She needed the extra $1,000, so that was perfect. And it would give her that continually. If she passed away, early, let's say she, passed away in 2 years, that money is never lost. That money is then given to her beneficiaries, the amount she didn't use. And because it's inside an insurance product, there's tax sheltering. So there's lower tax or no tax. So one thing, it was guaranteed. She knew exactly how much she was going to get. It would never change. And if she never did use it all, then it would still go to her beneficiaries. So people can create their own retirement plan with a few annuities. You can say, okay, and here's why it's important to have some guaranteed money. When we have, what am I thinking of here? When we have expenses that are fixed expenses every day of our life, our living expenses, we want to make sure we've got that covered. And that's what an annuity can do. If you have $4,000 a month or $3,000 that you have to have covered upon retirement, you know that no matter what happens, you're always going to have that. So any extra money that you got is just going to be a buffer. It's going to be your fund money. It's going to be your desirement money. I call it desirement instead of retirement, right? It's giving you the chance to have a bit of fun.
So she was able to look at like her Social Security covered this and that covered that, and what she needed left was the $1,100 or so per month.
That's right.
Cover it. And the $140 could cover that. So let's say if you're younger though, if you're younger than 72 and you maybe have $250 or $300 or something in a lump sum, are there easy tables to look at to figure out how much you could get in income off of an annuity at different ages?
Yes. Yeah. You can actually Google it and you can look up annuity payouts, and the different insurance companies they'll say, okay, male, female at this age, 40, 50, this is how much you would get. I did have a lady actually call me this week. She said, and it was just that. She said, why would I get less? I'm going to give someone my $200,000. Why would I get less than the man who has the $200,000? So you'll notice the difference because, again, I said it's part of an insurance product.
And women live longer,
right? Yay! Right. But we pay longer. So that money basically has to stretch longer. Okay. So it's the same thing I explained to her.
What happens if you outlive the cash value of your annuity? Do they continue to pay you even when it's been completely paid out and there's nothing left in there? There's zero cash value?
Cha-ching, and good for you. So they have actuaries will say, okay, a woman will live on average to age 86. This is how old you are today. This is how much we expect will pay you out using those numbers. But there are many people. In fact, I had another gentleman who had an annuity earlier back, in the late 90s, and interest rates were so high, and he got a great annuity payout. And he said, that should have ended at a certain age, but he said, I'm in 84, right? So he just kept getting paid. So it's your advantage at that point. But, they do their predictions as to how long they would be paid out. But yes, you get it. You just keep getting it.
Something else that I've heard discussed, because my mom, my sister, and I have all talked about this a lot. My mother is in her 70s, mid-70s. My grandmother lived to her mid-90s. So we've all kind of looked at the life expectancy in our family for women is pretty long. And one thing that we talked about was my mother does have some annuities that are within the annuity wrapper, but she has not turned them, she's not annuitized them for the income yet. What are the reasons? So when you put money in there, you get that insurance wrapper with the tax protection, right? Or the tax benefit.
It's a tax preferred treatment. Yes, okay. Basically how they say it. Yeah.
So is it after tax dollars that you don't get taxed on the growth, or do you actually get a tax deduction when you put money into an annuity?
You don't get a tax deduction when you put money into it, but it's called tax preferred because they take out the payments. Let's say they think they're going to pay you for 22 years. So they spread those tax payments over 22 years, as opposed to you taking out a lump sum and paying the tax on that money. Okay. So it's going to be to your benefit to have it spread out. And sometimes it can be zero tax at the beginning as you're pulling it out. The way they look at those payments coming out, they're looking at the first money coming out is your actual principal. So you're not paying tax on that again until you get to near the end, then you're paying more.
So it's like the opposite of a mortgage, where with a mortgage you pay almost no
Yes.
principal and all interest at first, and then if you get to the end,
Right.
almost all the
Yeah.
interest is paid off because they want to make sure they get their interest rate.
That's
Okay.
right. That's right.
So when you talk to someone, let's say that the woman you were talking to who had the 140,000, the 72-year-old woman, or someone approaching retirement, like how much of their overall portfolio do you recommend goes into these guarantees, like annuities and
Well,
insurance
if
policies?
possible, okay, it's going to vary for everyone on what their needs are, if they have other monies and things like that. But if you can, you can layer this too, which is kind of interesting. So if you did have 100,000 now and you put it into annuity, 10 years from now, another 100, and you want to start to pull it out, you can start to pull some out at age 60, some at 65, right? So the majority of it you'll want to pull out earlier. Just because we don't know longevity, how long we'll live, right? But you can sort of layer that money and pull it out. If the person has enough money from a few sources of income, then I say without adding up all those sources, let's get you to that level where you have no worries, that again, all your costs are covered. So that's why it'll vary with everyone. So it's not something you want all your money into because you can't change your mind once you're in an annuity. Right?
Okay, you're locked in.
So, yeah, you're not going to take 500,000 and say, here, all of it. You're going to take a portion of it and say, okay, let's lock in 100,000. I may do other investments with my other money. Okay, so you have to be very certain in going into it. And I highly say this, that it's not all your money, but it's a portion of it. And it's going to help you get to that level of comfort and ease where you say, I really don't have to worry about money coming in right now because my bills are all paid. Okay.
So if someone has IRAs as well, so like most of us in our 30s to 50s, you're talking about, we're paying into our IRAs, our 401ks, our retirement plans. Can any of that be turned into an annuity if that's our main savings vehicle during our working years?
Yeah, and I will sort of stipulate here because I am up in Canada, so your IRAs are like our RRSPs, but yes, the same concept. You've got tax sheltered investments. You can. Those investments, your IRAs, you can then take those and create, you still have to pay tax on them, right? But you're just going to put them into another investment tool. So that would be an annuity. But yes, you have to sit down with an advisor and probably an accountant too when you do that, though, just to see, is it beneficial for you to do that? What are the tax implications and things like that? But definitely it is, you can take money that's non-registered, so you've never put it into any vehicle, it's just sitting at a bank. You can use that money as well. And here's the other really good benefit, because it is under the umbrella of insurance, there are taxes, there are state taxes upon death that things are taxed differently. But when you have them into an insurance product, things do go directly to beneficiaries and they can bypass certain taxes that are out there. So it's a neat estate planning tool when you sit down and encompass it.
So does it circumvent probate? I mean, does it not, it's not part of the estate that's getting settled in court, the payment can be made immediately like with a life insurance policy?
It can in certain provinces here in Canada and certain states, yes. So you'd have to find out exactly how it is there. But I know here for sure it bypasses probate, and that can be huge if you have a large estate as well.
Okay.
Right? And you know what? Bottom line, we work hard for our money. I think we should have fun with it. We should be able to spend it and enjoy with our family. What we don't get to spend in our lifetime, it still should be passed to our family or to a charitable cause, whatever is of importance to you, and then least, to the government, right? If you have the option and if you set up smartly, you can do that. And that's such a great thing to do. Absolutely.
Well, and something that's come up for me lately that I've been wondering about for the past several years is the non-term life insurance, the permanent life insurance, universal life insurance, cash value life insurance, mainly because I have kids with special needs. And I know within the special needs realm, the idea of just, when my daughter was born, my husband and I each got a term life insurance policy for 20 years. So we thought, oh, well, she's just born, 20 years, she'll be in college, she'll be off on her way. If something happens to us, sure, there'll be some estate thing, our house, whatever. But she won't need the same care that if we die prior to her getting into college that she would need. She won't be a minor, at least. There won't be all those complications. And then,
Right.
2.5 years later, she's diagnosed with autism and then a white blood cell disorder, and she needs a lot of care. She's tube fed. She has a lot of stuff going on.
Yes.
And realizing that she will, even with Medicaid, always need support and help, will probably always need someone living with her full time, which totally changed the goalposts for us in terms of our future planning financially.
Right.
So I have not yet purchased one of these policies, but I've been talking to different people within the special needs world. And when you know your child is going to have needs that outlive you, your estate planning is no longer the end of your life. It becomes the end of your child's life.
Yes.
So in talking to somebody like me, who wants some guarantee for my daughter after I'm gone, I want to make sure there's more than enough and that she'll be comfortable, well cared for, can have education, can have everything that she needs. What kind of advice do you give them in terms of these other insurance vehicles besides term life insurance?
Okay, great question, and so important to know that those are some options and some things that you have to think about. That you're in a great situation. When you started, like you mentioned, many people get married, they get a house, they'll buy a whole chunk of term insurance, and that is a great thing to do. It's inexpensive, but it just covers each other for the what ifs. But here are some benefits of that term insurance. So when you get to your situation, Jen, I would say, okay, so you have a forever need. Your need isn't a 10 or 20 year. You want this for a lifetime. Lifetime and needs need to be covered with lifetime protection. So you're talking about a whole life insurance policy, and you're talking about a universal life policy. Okay. So think of in terms of renting a home, that is term insurance. You're renting it, right? You don't actually own it. You don't have cash value, but it's there while you're in that home. And that's what term insurance does. It stays there usually till age 85, but every 10 or 20 years, it gets more expensive. And what happens with the permanent insurance is more expensive right off the bat. You're going to pay more, but you're going to get more. So it's like owning that home. You actually, you've saved and you're ready to buy that home. You're going to have that home forever, that equity forever. You've got something valuable that you've built up. So
and the payments I looked at were pretty close to our mortgage when, if I wanted $1 million for each of us. So
yes.
It was about our mortgage again.
It's about a mortgage. Okay. So yes. It's crazy. That's why people buy a big chunk of term. But with you, I get that. So now you have to make it fit a budget. So here's the catch-22. The sooner you can have permanent insurance, the better it is cost-wise, because it's all age-related. The older we get, closer we get to a death, that the premiums are going to get higher. So if you're 30, 35, 40, and you have some money to buy permanent whole life insurance, you should do that. You don't have to buy it all then either, because I do get it. It's going to be costly. And you want $1 million to leave for them. But then again, you can sit down and have future needs analysis as to what, a $500,000 policy or 300 would get them down the road too. And in the whole life policy, you're going to have some growth in it. So it's going to be built in there for inflation, right? So you can grow that policy.
Can you do lump sum deposits? I mean, like if I knew that I wanted to get to a cash value faster, could I put cash value into it?
Yeah, you can.
To do?
Yeah, you can, and it does make sense. Well, it really depends on your financial situation, but I've had people with a lump sum of money that said, you know what, this money is sitting here, I want to put it into an insurance policy. And if anybody's listening, they go, why insurance? It is the best investment for the dollar you put out. You put out $1, someone will get back 1,000. Okay, so you could never do that in a traditional savings environment. So you can put in a lump sum, and what that'll do, depending on the plan, that lump sum can sort of carry you for a while. It might just say, okay, now I don't have to make any more payments for a while. So it can stop that monthly payment. If things were difficult for a while, for a year or two, it'll sort of sit in there and pay for the plan. It can add to the plan. It can add to the total amount that's going to be there. And if you put something in now and it's got 20, 30 years of growth, it's going to really do well inside that policy. So there are monthly payments you can do, and you can do lump sum deposits as well. And actually, I just want to tell you one thing. I had seen an example of an older grandmother. So this might sort of give you some ideas too. Who had money that she was leaving for her grandchildren. Her husband had died and left her, enough money for her lifetime, a pension and everything. But she had $100,000 in her savings account that said, "This is going to stay here till the day I die for my grandkids." Well, taking that $100,000 and putting it into a lump sum policy gave her grandchildren a lot more, right, than the $100,000 would have ever done. It helped with her estate taxes because there was no money left in for probate. And it just sort of, there are options that way that work out really well.
Are you able to put things besides just cash in a policy like that? Like if you have real estate or other things of worth, can you put them into an insurance policy, or do they have to be liquid?
No, it has to be liquid. Yeah.
Okay.
Good question. I never thought of that before. Yeah.
Well, I was just saying in terms of avoiding estate taxes, like if you have land, say, or properties, is there some way to avoid probate?
No way to avoid it, but you could be smart about it and just learn, what's the best approach to taking it, right? That would be the least amount of taxes that you're going to have to pay.
Okay.
Right? And then you definitely want to talk to your professional accountant about that too.
Okay. And my other big question that I had, again, this is some from the Tony Robbins book, where he talked about getting these term life insurance policies and being able to borrow from them. He said this is one of the things that the rich people do that most
the whole life you can borrow from.
Oh.
Yeah. So
I apologize. I just pulled my earphone out for a second. Okay.
Okay.
All right. Say that again.
You said the term policy where you can borrow from, but you just wanted to say permanent. Yes, the whole life. Yes, and you know what? There's some great stories to that. In fact, Walt Disney, that is how Walt Disney himself, when he first started Disneyland, Disney World, he came up with the money from his life insurance policy. So he had the equity. So think of it as equity in your home. You know how you can leverage that money. So you have equity in your life insurance policy that you're putting money aside. It's tax sheltered. And when you go to use it, there's a few ways you can use it. You can borrow against it. So you're sort of creating your own loan. You can actually pull it out if you didn't, want to borrow against it. And you can leverage it in just different ways. But yeah, the whole life insurance and the universal life policies have the ability for you to do that, for you to leverage that money and use it for whatever needs you have. Great tool.
Can that be a preferable situation to taking out a bank loan? From yourself, will you be able to do you have any control over the interest rate that you pay the money back, or is that the policy determining that?
It's written into your contract when you buy your insurance. Okay. So if you're going to get a loan, it might be prime plus 1%. Traditionally, I would say it's not your first choice to go for a loan, because I think if you've got good credit, you can get better rates.
Okay.
Backup to say, at least I have that there if I need it, or even temporary. You could borrow it and say, I needed it for a vehicle, whereas you may not have been able to get the money elsewhere, and then you're going to put it back, right? But it should be as an alternative.
Okay. And as far as withdrawing that would reduce, if you just withdraw it as opposed to borrowing against it, that just reduces the cash value of it.
It does in some policies. So when you're sitting with an advisor, you have to ask those questions, because so many policies are different. Some will not even let you borrow it from it, or actually pull it out. They'll only let you borrow.
Okay.
Right. So you just want to make sure that if that's something you're thinking of, that you get the right plan that allows you to do that.
Okay.
Those are questions, honestly, I know this is a lot of information to take in, but even if someone's making notes, if you are going to talk to someone, find out what's important to you. That, if you want cash value in there, if you want a policy that'll never cost more, that the premiums are locked in now when you're 40, as the same as when you're 80, so you want to have some guarantees. But I will say that, insurance products are changing drastically. Come 2017, there are a lot of different laws coming in, because we all went, how a dentist will go on a guide from, a certain year when you're paying a certain fee for dentists. Insurance has not really had many changes, anyways, here in Canada since 1982. So they're old actuary statements, old investment returns, and rates have been so low now that the reserves that all insurance companies hold now, they're running out of money. So you'll see prices going up. You won't see them as rich inside the amount of money and the investment and the return you can get. So there are some changes. Absolutely.
And I was wondering, here in the U.S., we had these new fiduciary rules come in as far as who can sell what in terms of, having kickbacks and having, promoting certain products over others in terms of doing what's best for your client, regardless of what's best for the seller of the insurance policy. If it's an investment, isn't
that great?
Advisor. It is. It's great for the clients for sure.
Yes.
I'm curious if that is having any effect on the overall pricing in the insurance market.
I think it does, and I think it sort of brought into light what people never even knew to ask before, because traditionally insurance brokers, right, we would sit down with you, there's no fee to do that, and we get paid commission from the companies we represent. Mm-hmm. A lot of times you may find someone who do a fee for service as well, where they'll say, okay, I'll put together a complete portfolio for you of your needs and your financial analysis. This is my fee. Mm-hmm. And what it's actually changing to, Jen, is we're changing to a system where there will be no more commissions to advisors. When you sit down with an advisor, they'll say, here's my fee, mm-hmm. and this is what I'll do for you. And then you can sort of shop it and see, okay, what would someone else charge me for that too? Mm-hmm. They're sort of steering away from the commission and then going more towards a fee-based kind of product.
Mm. How do you feel about that?
Good question. I think I'm a little nervous about it because I've done this for so many years without having to bring that up and just offering the best advice, because regardless of what I'm making, right, I'm still selling them a product that I get paid quite well for. So sitting down and talking to someone about that up front, I think I'm a little leery because I think they may not be open to the best solution, right, knowing that they have to pay. So I'm not too sure. It'll be interesting, right?
We may have to revisit in another year or so and see what's happened in the meantime.
See where it's going, for sure.
Yeah.
I was talking to you before we got on here about something that I was wanting to share as well. You've done different things with all the great people you've had on your podcast too about budget and stuff. And I wanted to talk a little bit about the psychology of money. Mm-hmm. Just even, how do you come up with this money for your life insurance premiums, right? And you said the cost is expensive. And the idea of a reality check of doing your budget, but just finding the desire that this is important to do. Mm-hmm. So somewhere it's going to come out of there. And when I talk to young entrepreneurs as we're making more money, life gets busy and you forget to do that planning. So plan to make sure that you're putting some aside, because if something crazy happens to the internet and the money is not coming in, you want to make sure that you're doing that 10%, which is still pretty standard across the board, right?
Mm-hmm. 10%. When I bought my first life insurance policy for my husband and myself, right, the year my daughter was born, what we did was, I'm not sure if this is what you would advise or not, but we sat down with an advisor and worked out. It was in 2006. So it was right before the big recession. And we were able to find 2 bonds that had 5%. They were municipal bonds. They were a little over 5%. I bought $10,000 worth of each bond. And the yearly amount that came off of those bonds more than paid our annual life insurance policies. So I just set it and forget it.
That is awesome.
I know. And we did lose one of them recently. They cashed it in. We were not going to sell it. They forced us to take the money back. So I just put enough in that account, in the brokerage account, to pay it. But that's kind of how I've done it, is we pay annually. And I try to make sure that I had, I like doing that with different segments of my life. Okay, this income here pays this exact thing. And then once that's set up, if I can automate it at all, I try not to touch it. So that was one of them, was these 2 bonds. And 5% is not, at that time, it was not so out of the usual to 5% bonds. Now it's almost impossible. And I know one thing you were saying too with interest rates, how they used to be higher and how they've been so low. I think part of people wanting to be in these more aggressive growth areas like the stock market and the EFTs and everything is that savings account. I mean, we're not getting any interest on regular savings. Bonds aren't fantastic. Money markets aren't very good. I mean, there's so few ways that we can feel like we're putting our money to work and it's actually bringing a return. I mean, I feel like that and actually credit card debt are the things that have made us feel like our standard of living hasn't dropped dramatically, because for a lot of people, you know, our incomes have been stagnant. If you work at the same job for a long time, those tiny cost of living raises aren't keeping up with inflation anymore. So people feel like the only option is to go into something like the stock market. But hearing about these guarantees, even if it's not as aggressive growth, if you have the tax preferential treatment for the taxes and have the guarantee of income once you click that on, how long do people usually wait to annuitize an annuity? Do they usually click it on immediately, or do some people do what my mom's been doing and leaving it in there for a while?
Most older people will want that started right away because they're looking at this as another revenue for their retirement. But yeah, you can invest and have it put aside and then say, yes, I'm not going to touch that until a certain time. So there are two different ways to go about that.
And my understanding from her was the reason to wait was to try to get the higher, you know, the older she is, the more the monthly amount will be, right?
Yes. So actually very good. So some of them in the structure of the plan, they will tell you that at the beginning, if you contribute a certain amount and if you wait to this age to pull it out, it's like a pension, you will get a certain amount. But if you can wait a little bit longer, yes, there's going to be a higher amount coming out for you. So
kind of really like Social Security. You know, if you wait to 72 instead of 65, you get higher payments.
Right. Yeah. So it really depends on, you know, if you're single or if you have a spouse and you've got some help. So all those, you know, numbers make a difference once you add up what you've actually got coming in for retirement.
So it does seem like such a gamble when we don't know how long we'll live. You know, that's the hardest part, is how long will we live? How much will we need? And, you know, another thing we've been talking about with my mother too, end of life coverage. You know, with her mother living so long, she did need to have significant nursing needs towards the end of life. Do you counsel people on that kind of insurance as well?
Yes, and you might want to write it down. It's called long-term care.
Long-term care. I have my whole notebook here from our talk.
Long-term care insurance really has not been given the accolades that it should get. People maybe don't know about it or haven't asked, but you know, as we age, if you're working with an employer, you have a disability pay, you have some kind of benefits. When you're beyond that, and if you need care from a nursing home, there's if you cannot perform 2 out of your 6 daily rituals like bathing, dressing, feeding yourself, toiletry, as time goes on, as you get older, this insurance product will pay you. It's almost like a monthly income. So it's almost like a disability in a way that you can't perform those functions. So it's almost it's called a living benefit, because you're not going to die to get this. You're going to live, but you need some financial help. And there's great plans out there that you can start. Usually people won't take a look at them until maybe they're in their 50s, because they've had parents and they've seen what's happened and they see the cost, right? So you can talk to an advisor and ask them to explain long-term care. How it works basically as income to you when you need it. You could be in a nursing home or you could be at home. There are different plans and different amounts. And sometimes when I say when you're trying to save for everything, again, look to see where your money is coming. If some of your Social Security money coming in isn't, you know, everything you need, maybe you could take that and put it aside into a plan. And it's going to be guaranteed there for you for a lifetime as well. Have you heard about critical illness insurance?
No, but I was going to ask about disability for entrepreneurs, because I think, again, when you have an employer, you know, when you have an employer, you're paying payroll taxes, you're paying Medicaid, Medicare, disability, unemployment. When you work for yourself, you know, you pay self-employment taxes, but you may not be eligible for a lot of the benefits that you would get if you had a employee insurance policy, which often has some kind of disability as well, right?
Yes.
So, let's talk about both those things then.
Okay.
Yeah.
So when you're in the working world and you do have disability benefits, it's excellent for you to have any kind of plan that you can, you know, that because it's coming from your group employer. When you become one of the many of us who are entrepreneurs and on our own, it's quite interesting. I just had done a little test. I had phoned about 40 different self-employed individuals. A lot of them were in the trades, and I said, I'm representing my insurance company. Can you just tell me, do you have life insurance, disability, or critical illness? Honestly, I'm going to say 9 out of 10 did not have any of those coverages. They're busy trying to make a living, and I get it, and money is scarce, so they don't think about doing it. But if a disability hit you, if you got hurt, if you got sick, you are it. You're the income, right?
I think about that with my family too, because
Do you?
either my husband or I were completely taken out for one reason or another, it would be very hard for one of us to do full-time work and take care of my daughter. And plus, if we had to take care of the other spouse, it would be very difficult. But we don't have this insurance. We have the term life insurance that I told you about.
Right. And that's what I've had. Someone asked me too. They said, Diane, my husband's been hurt. Do we have disability? And I said, you have life insurance. So it's onus upon advisors to go through all of the different kinds of insurance. And I know sometimes people might say, well, you're trying to sell me everything. Not really. We're trying to advise you of the what ifs and how you might be able to cover them with insurance, right? You don't, like the house scenario, you don't have to get the best one out there. You can get a smaller policy, right? Even one that'll take you for 10 years until things start to pick up. So you can always come up with a budget. Even you could say to an advisor, this is how much we have with $200 a month. And these are all the things we need. How can we make it fit? So sometimes you're going the opposite approach, saying, this is how much I have. These are my risks. I need them covered. What can you offer me? Right? So it's another way to look at it that way.
Yeah, that's interesting. And, I have seen studies here in the U.S. at least that when things are taken out of people's paychecks before they see them, say you have, a company paycheck, they take out your 401k, they take out, your health insurance, your portion of it comes out before you receive that check. How it's, it's out of sight, out of mind, and people don't notice that. Something I've tried to help people do just with their own personal budgets is find some way, like we try to set up automatic transfers so that as soon as money, if they transfer twice a month from PayPal, if they're consultants or coaches or things like that, the next day have a percentage transfer go out to their savings account or to, whatever area they're working on right then, so that you don't have much time to spend it in sort of that same way. But But it is harder when you're self-employed, especially if the income is irregular, then you don't have that exact amount necessarily to put towards something every single month.
Yes, I know, because your money coming in does fluctuate. So even if you could, in your mind, I've said this to a few self-employed people, if you could think of it in a percentage, maybe anywhere between 2 to 4% of your gross income, set aside for your life insurance, your disability, your health insurance. So if you were making, $50,000 a year, and you're looking at, okay, I might need $1,000 to $2,000 a year. You're looking, $100 a month, in that area, $150. I think that would be a good number to go with, between 2 and 4%, depending on your needs. You'll definitely get some, and even if it's term, get the term, because the main thing is to get the right amount of insurance, never mind the right kind, because no one's going to thank you if something happened and you got $100,000 whole life policy because it's all you can afford, that you had a $500,000 need and your husband passed away. You should have got $500,000 of term insurance.
That is a good point. That is something that we looked at too when we were trying to figure out if and when we could afford the whole life or the permanent insurance. Is should we buy another term kind of to overlap and then get the convertible where we can convert at some point from term to whole life. And I'm using myself as an example. I realize this is something I love about the show as I get coached. Of you talking about my situation, but I also am not the only one to have these different, some people will have children with disabilities. Some people will have parents in their 70s who are trying to figure out these things. So I feel like it will apply across the board. But yeah, I think that's a really good point you just made. If I can't afford the $1 million whole life and policy because it's another mortgage, basically, I'd be better off doing $500,000 or a term life.
Or a term, yes. And you know what? You'd mentioned something important here, conversions.
Yeah.
So conversion is It's a privilege written into this contract. So you buy term.
Okay.
Let's say you bought a 20-year term. So from now for the next 20 years, you've got this coverage. Any time in that 20-year term, you have the right to convert that from a term policy to a whole life permanent policy. And that is without any medicals whatsoever. So where this is valuable to you, and I've had it happen to clients where one of them had a heart attack. Okay, so they wanted to maybe buy some permanent insurance. We can't give them new insurance. It's just been too new since they've been sick and had this heart attack. But your term conversion has the ability to say, oh, I want to convert to permanent. You can without any medicals whatsoever. So it's a nice little thing to have there as a buffer, just in case, poor health, finds you when you want to convert.
I think that's probably what we're going to do. Unfortunately, I just turned 40 this year, so I bumped into the next age box.
You did it with style.
Yeah, but oh well. I figure now is better than 5 years from now, anyways. But yeah, I think that's probably what we'll do. And I was thinking one thing about the percentage, and I think for entrepreneurs more than anyone, that is an important way to think, because we already think about our gross income and tax percentages for paying our estimated taxes.
Yeah.
A lot of us think about the percentage of salary that we pay ourselves out of what we make, because we have to keep a certain amount for operating costs. So I think that's a great way for all entrepreneurs to think of it.
Yeah, I think that can help too, for sure. Yeah, gives you a starting point anyways, right?
Yeah, that's true. So if people are listening to this and are thinking, oh my gosh, I need some help with this, how can you help people figure out what they need or point them in the right direction? Do you have any tools or programs that can help get them started?
Yes, well, actually, we had sort of mentioned that. I've been working on a launch that I'm thinking it's going to come out in January. I hoped it would be out earlier, but 2 programs. And if you're interested in finding out about it, you can email me and I'll put you on my list. But I'm going to do a very basic launch just on, the financial freedom basics and what that means. It means setting the plan, protecting your plan, and having some results that are going to be guaranteed. And this launch is going to be, it's probably going to be a 3-day kind of course, just to get those 3 basic things covered and get you started. So now you're armed with something in your hand, and you go and sit down with an advisor and say, okay, here, I'm ready to start something. What can we do? Okay. So if you want that information, if you're interested and say yes, put me on the list, you can email me and I'll do that. Starting in the new year. And one other thing I wanted to say, and I wanted to thank you for having me share my experience here with you and your listeners. Although I am in Canada and the rules are different here, anyone listening, this is the beauty of being an advisor. We know people all over. So if someone's listening in Arizona or New York and they like what they're hearing and maybe they're feeling a connection and it's that no trust like factor, I'm more than happy to talk to you, give you a little bit of information, and connect you with someone in your hometown, in your city, that knows exactly what you've already asked and what you want done, and then I can hook you up with someone close by.
That's fantastic, because I know personally I do like to go into an office for this kind of thing and sit with somebody. There are plenty of things that I'm happy to do online. I use lots of financial apps for different things, and I've tried lots of stuff. But when it comes to like my kids and our estate, like this morning, I came in with this giant folder to the estate planner to be like, is everything right with our special needs trust? Have the laws changed? Do I need to do anything? And I just like to be able to see that he looked at it. I could see him looking at it and I could ask any question. I love that we have this technology that we can talk, but sometimes it is really nice to have someone that's been recommended by someone you trust to sit across.
I'm so glad you said that. Yeah. And your appointment, I think, should be that, and they'll sit down and answer those questions for you and just give you that feeling of you've made a good decision and you're in good hands that way. Absolutely. You can research online, right?
Yeah.
Or ask questions, but you definitely want to meet.
Well, and I think for anyone who's not quite to that point yet, who's not quite ready to make that appointment with the person across the table, it sounds like your course will help them gather all the information they need and get everything together.
Exactly. Get you that boot in the butt and get you started, right?
Yeah, that's good. Because, when I did do our special needs trust, it took me over a year to finish that from the time I bet. From the time I paid for it, and he got me all of the forms, and I had to the hard part was making the decisions. There were some very big decisions that we had to make. And some of them we just mulled over. My husband and I didn't agree. And it took us a year to get from paying him for everything to finally signing everything and getting it all notarized and all, everything established. So we probably could have used more of a kick in the butt, really.
Right on. Well, I can share with you.
I just felt this weight off my shoulders. I felt like as long as it wasn't done, there was a really high chance that I might die and something would happen to my kids. I know. I felt like, okay, now, if something happened, it wouldn't be the same level of tragedy because everything's taken care of. So I felt somehow that would make it not happen. You know what I mean?
Right, I do. And you know what, though, good for you, though, women do that. We do put that responsibility on our shoulders, and to our credit, we do think of those things because life happens, right? And you just want to be prepared. So yes, absolutely. I'll send it to you too, the link for the information on that course, and that's just being prepared and getting started. That's all it takes, right?
Fantastic. Yeah. And I do want more information on insurance. So I probably will sign up myself and come learn some more. That's kind of where my brain is right now. So for anyone listening, if you don't quite feel ready for buying your insurance right now, but want to learn more about what you might need for yourself and your family, and actually I think anybody would benefit from this if they haven't really gone into their own estate planning, insurance planning, especially the annuities. That's something I've had a lot of questions about. So I am excited to learn more myself. And thank you so much, Diane, for coming on and sharing all of this with us.
Oh, it's been my pleasure. Thank you too for having me.
And we will put a link to, what is your website? Say it for the listeners who aren't watching us.
Okay, the easiest way to find you would be through my name. It's DianeRusk.com. So it's DianeRusk.com.
Okay, and we'll put that in the show notes. So if you are listening on your phone, you should be able to scroll down into the show notes and find it. If you're watching this on YouTube, we'll put it just below the video in the description. And it will also be on my website where I have the home of the show for both audio and video. And somebody's coming in right now.
I'm sorry.
We're still we're just wrapping it up. I'll be right out.
Which one's Tolu's margarine?
The yellow one.
The yellow one.
Okay.
Sorry, girls.
Oh, I love it. That's okay.
My daughter has severe allergies, so everything's non-dairy in our house, but we do have one Earth Balance butter, the green one, the olive oil one that we can put onto Miffy's toast if she has some wheat. Tallulah cannot have wheat.
Oh, wow.
Our kids have different eating needs, so we have to divide very carefully between the groceries.
Well, you're an awesome lady. You got a lot going there, and you're really organized in what you offer through this information and letting myself and other people share. I think that's really valuable, so thank you so much.
Oh, thank you. I appreciate that. I sure hope so. I think the more we can all talk about this and help each other figure it out, the better off we will all be, because I grew up not talking about this. And
that's true. That's another topic.
A lot of women didn't talk about this growing up, and now a lot of women find themselves in a situation of having to handle things they don't feel prepared for. So let's get prepared by talking to professionals like Diane. And I will see you all next week. Thank you. Bye, Diane.
Bye. Thank you.